Welcome to Market Brief After Hours. It has been quite the roller coaster week in global equities. We are looking at a fragile ceasefire between the United States and Iran, mounting inflation concerns, and energy prices that just refuse to settle down. Let's break down exactly what happened and what it means for the days ahead.
It really has been a delicate balancing act for investors. We saw a strong appetite for risk earlier in the week, but by Friday's session, a much more cautious tone took over. Traders are clearly reassessing whether this easing of geopolitical tension is actually going to last, and how the potential spillover effects might impact inflation and central bank policies.
Let's get right into the numbers, starting with the major U.S. indices. Despite that Friday hesitation, it was actually a remarkably strong week overall.
Absolutely. In fact, strong gains earlier in the week helped major U.S. indices secure their best weekly performances since November. Let's look at the Dow Jones Industrial Average first. It fell by 269 points, or 0.56%, on Friday to close at 47,917. But despite that daily drop, the index still advanced 3% over the week, supported by those early signs of easing tensions.
And the S&P 500 followed a similar pattern, didn't it?
It did. The S&P 500 slipped just 0.11% on Friday to finish at 6,817. However, it recorded a weekly gain of nearly 3.6%. Again, that marks its strongest performance since November.
Then there's the Nasdaq, which actually managed to buck the Friday trend entirely and post a daily gain.
The Nasdaq Composite was the standout, rising 0.35% to close at 22,903. That was driven largely by continued strength in semiconductor stocks, specifically names like Nvidia and Broadcom. Overall, the Nasdaq gained a very impressive 4.7% over the week.
Those are massive weekly moves. But hovering over all of this is the inflation data and what's happening with the consumer.
That is the dark cloud right now. U.S. consumer prices rose 0.9% in March. That brings the annual rate to 3.3%, which is the highest we've seen since April 2024. And if you look under the hood, it is almost entirely driven by energy. Energy costs surged 10.9%, with gasoline prices jumping a staggering 21.2%. Core inflation, however, remained subdued, rising just 0.2% on the month and 2.6% year-on-year, which shows the underlying pressures are somewhat contained.
But that headline number is clearly taking a toll on everyday households.
Without a doubt. The University of Michigan's Consumer Sentiment Index absolutely plummeted in April to 47.6. To put that in perspective, that is the lowest level in its 74-year history. Households are deeply concerned about the economic impact of the Iran conflict and these rising inflation expectations. We also saw U.S. factory orders stall for a second consecutive month, remaining unchanged at $619.6 billion, weighed down heavily by a decline in transportation equipment.
Before we cross over to Europe, we should talk about how the Asia-Pacific markets digested all of this, especially with the ongoing disruptions in the Strait of Hormuz.
Asia-Pacific markets actually advanced quite broadly despite the caution. Japan's Nikkei 225 gained 1.84% to close at 56,924, though the topics remained flat. Over in China, the CSI 300 rose 1.54% to 4,637, supported by improving producer prices, which turned positive at 0.5% year-on-year.
And we saw some losing streaks being broken elsewhere in Asia.
We did. India's Sensex added 1.2% to reach 77,550, which finally snapped a 6-week losing streak. South Korea's Kospi also climbed 1.4% to 5,859. And a really interesting data point came out of Taiwan. Their exports surged an incredible 61.8% year-on-year, reflecting massive demand for AI-related goods.
But the energy markets are still a massive focal point. How are oil prices and bond yields reacting?
Oil prices actually slipped below $100, but the tension is palpable. WTI crude fell 1.33% to $96.57, while Brent crude dropped 0.75% to $95.20. The uncertainty around the reopening of the Strait of Hormuz is keeping everyone on edge, especially with attacks on Saudi infrastructure reducing output capacity. As for U.S. Treasury yields, they edged modestly higher following the inflation data. The 10-year yield increased to 4.321%, the 2-year yield climbed to 3.804%, and the 30-year yield reached 4.913%. It complicates the Federal Reserve's policy outlook significantly.
Let's pivot to how the European markets handled these mixed signals.
Europe was a bit of a mixed bag, but generally leaned positive. The Stoxx 600 rose 0.4% as investors tried to balance geopolitical optimism with some fragile economic data. Over in France, the CAC 40 gained 0.2% to hit 8,260. Italy's FTSE MIB climbed 0.59% to 47,609. Though it's worth noting Italy's industrial production only rose a modest 0.1%, missing expectations.
What about Switzerland, Germany, and the UK?
Switzerland's SMI added 0.18% to close at 13,183, even though their consumer sentiment dropped sharply to -43. Germany's DAX 40 ended broadly flat at 23,800 after giving up some early gains, and they are dealing with inflation accelerating to 2.7%, again driven by energy. Finally, the UK's FTSE 100 edged slightly lower by 0.08% to close at 10,595.
We are going to take a quick break. When we come back, we will dive into the Forex markets, check in on gold and silver, and break down the biggest market movers of the week. Stay with us. Welcome back to Market Brief After Hours. Let's shift our focus to the foreign exchange markets. There was some fascinating price action this week, especially when we look at the moving averages.
The technical setups right now are incredibly interesting. Let's start with the euro against the US dollar. Euro USD closed at 1.1728, rising 0.25%. What's crucial here is that the price has now cleared some major hurdles. It is positioned just above the 50-day simple moving average at 1.1674, the 100-day at 1.1689, and the 200-day at 1.1672. That signals some very real improving near-term momentum. Immediate resistance is right at 1.1740.
The British pound also had a solid showing against the dollar.
GBP USD closed at 1.3469, gaining 0.24%. Similar to the euro, it moved decisively above a confluence of key moving averages. It is now trading above the 50-day SMA at 1.3436, the 100-day at 1.3427, and the 200-day at 1.3415. Buyers are definitely regaining control here after a period of consolidation, aiming for that psychological 1.3500 level.
Let's look at the US dollar against the Canadian dollar.
USD CAD climbed 0.19% to settle at 1.3834. The big story here is that buyers successfully pushed the rate above the critical 200-day SMA hurdle, which sits at 1.3815. It's also well above its 50-day and 100-day averages, reinforcing an uptrend we've seen since early February. If it sustains this position above 1.3815, we could see it challenge the 1.3900 level soon, especially since Canadian unemployment remains steady at 6.7%.
And USD JPY seems to be on a relentless march upward.
Relentless is the right word. USD JPY closed at 159.30, up 0.24%. It is maintaining a clear bullish structure across all timeframes. It is sitting comfortably above the 50-day SMA at 157.33, the 100-day at 156.82, and way above the 200-day at 153.10. The market is now looking at that massive psychological barrier at 160.00.
Let's touch on the metals. Gold and silver had slightly different weeks.
Gold pulled back a bit, closing down 0.21% at $4,760. It's pausing within a wider uptrend. Right now, it remains below the 50-day SMA at 4,911, but it is holding strong above the 100-day at 4,663 and the 200-day at 4,154. That 4,700 region is acting as a very important support zone.
And silver?
Silver actually rebounded. It closed at $76.33, rising 0.85%. Buyers really stepped in near key support levels. It's now trading above the 100-day SMA at 75.85, though it is still below the 50-day at 80.03. The longer-term trend is still very constructive, supported way down by the 200-day SMA at 59.21.
To wrap things up, let's look at the individual stocks making the biggest waves. There were some massive double-digit swings.
There certainly were, starting with Organon. Shares of this Merck spinoff absolutely surged, jumping 28%. This was driven by reports that India's Sun Pharmaceutical Industries might be putting together a $12 billion takeover offer.
On the flip side, Fair Isaac took a heavy hit.
The credit scoring firm saw its stock tumble 14%. That came right after Barclays lowered its 12-month price target to $1,950.
We also saw some major action in the AI and tech space, both good and bad.
Yes, CoreWeave had a fantastic week. Their shares rallied 11% after they announced a multi-year compute agreement to support Anthropic's Claude AI model. But it wasn't all good news in tech. ServiceNow slid more than 7% following a downgrade from UBS to neutral. UBS basically cited reduced confidence in the firm's AI positioning.
And the cybersecurity sector had a pretty rough time as well.
It was a broad sell-off. Cloudflare led the retreat, plunging more than 13%. But they weren't alone. We saw notable declines in other major players like Okta and Palo Alto Networks, too.
It really highlights how quickly sentiment can shift, whether it's based on geopolitical risks, AI positioning, or inflation fears.
Exactly. A strong weekly rebound across global equities shows what happens when risks appear to stabilize. But Friday's hesitation proves confidence is fragile. Markets are being driven by the interplay between energy prices and inflation expectations. With the Strait of Hormuz operating below normal capacity, investors are going to remain very cautious, watching for clearer signals on supply stability and the broader economic trajectory.
That is all the time we have for today's breakdown. Thank you for tuning in to this comprehensive look at the week's market action. If you find this useful, please follow Market Brief After Hours. We will see you next time.